This merry week, I'm going to show you the UK stocks I bought, the top riser and faller in the portfolio, as well as the stock tip of the week. If you find the video useful or just enjoy the series, please drop me one of these to support the channel. According to Google Finance, the FTSE 100 is down 0.42%, the FTSE 250 is up 2.06%, and the S&P 500 is up 0.52%. My portfolio for the second consecutive week has managed to outperform the markets and increased by 4.98%. And I think this is the start of something quite special for UK investors. With interest rates seemingly going to be remaining low for the foreseeable future, it means that people are pushed, that's not pushing, but they're pushed towards the stock market for returns on their money. This combined with the UK economy, which had struggled more than any other developed nation except Spain, I think the UK is in for the best short-term recovery compared to the other nations. That's because we're so largely built up on services, and at the moment, as spenders, we're saving a lot more money. This means that that money is on the sidelines. Sure, they could save and invest it for the rest of their lives, but majority of the population likely isn't going to do that. And what they're going to do is, once there's more of a certainty, or maybe job certainty, then they're likely going to go out and spend this money. And that once that pandemic dissipates, that our GDP could recover a lot quicker than other nations and therefore provide a better economic return, although the economy is not the stock market, and for all we know the stock market could be well ahead of the economy at the moment, meaning that an increase in the economy may not impact the UK stock market. Which brings me on to the first top topic of the week, and you may have seen the thumbnail or how I had posed in that picture, and obviously it was to represent the Brexit deal. And whilst I don't talk about politics, nor do I have any political agenda, which may be weird to some of you that maybe are political, I would just like to talk about the facts and what it could mean for UK investing. I'd like to also clarify I've not read this document. I don't have that spare time on me. I enjoy the Christmas period and that's that. But the idea is that the Brexit deal is largely complete and that it just needs to be passed through a few select areas, which I believe is the UK Parliament and the EU Board of Commissions, something like that. Basically, we can relatively assume that it's likely to be passed, as anyone that opposes it is going to be looked negatively upon. But then should this deal be passed, we no longer have this large negative force looking down on the UK markets, and this could provide or give an opportunity for us already invested in the markets. That's because people may be more willing to put their money into the UK stock markets as we become a perhaps more stable economy. Obviously, the idea of a no-deal Brexit was very scary, and therefore people were avoiding putting their money into the markets. From the investment perspective, I think the pound could rise. Obviously, we had seen it weaken quite significantly over the last 4.5 years since the start of Brexit. I think that this, whilst it may not go back to where it was peaking, I think that we could definitely see the pound strengthen against the euro and certainly the dollar. This would mean that UK-based assets, those specifically in the FTSE 250, those that are very domestically tied to the UK economy, would benefit from an increase in the pound and likely see their share prices increase. On the other hand, though, the FTSE 100 stocks that are globally diverse and earn a majority of their money in other currencies like dollar and euro means that they will actually probably negatively lose out from this and actually mean that they may lose some value in share price. Therefore meaning that Brexit could be that much needed push that we needed in the UK markets, and now this could be the start of something really good. The next top topic of the week is Boohoo, and I was quite surprised to see that they finally had their auditor replaced, which used to be PwC. It's now been replaced with PKF Littlejohn. Although there has been some scrutiny over the size of this accountancy firm, and that's because they're not the big four, and there seems to be some kind of negative bias tied to these big four companies. If you haven't got it, is looked down upon. The share price, however, hasn't reflected that and looks a lot more positive, but we'll talk about that later in the video. The point is that PKF Littlejohn are the 7th largest accountancy firm based on stock market clients, and I really don't think this is a bad option, although I've seen a lot of speculation like the LSE chat boards saying, well, this just means they could be bought out by the company and therefore fraud or cook the books. And the idea that PKF Littlejohn is too small to monitor a £4 billion market cap sounds a bit ridiculous to me. I'm not too excited by this, nor am I negatively put off. I think this is a slight step up, meaning that Boohoo has a little bit more security, and as long as they continue improving their governance issues and providing there isn't more articles on pay that's too low to be sustainable, then Boohoo should have a fantastic 2021. But this really depends on their trading update in January. Hallmark, one of my companies in the portfolio, actually made an acquisition this week for Static Systems. This company provides a technology that increases or decreases the response time taken for emergency patients. And this fits with Hallmark's purpose of growing a safer, cleaner and healthier future every day. This technology allows hospital patients to alert healthcare specialists in an emergency situation, which combines very well with another one of Hallmark's businesses, Centrac. Centrac has real-time locating system based on healthcare assets and also patients, so when the two are combined or work together, they present a strong synergy. Hallmark, as usual, are very likely going to leave this company to be continuing at their own pace, but obviously they will have that oversight and provide them with that size, scale and scope to help them develop the business and hopefully grow at a faster pace. Although on the contrary, HLMA was actually the largest faller this week, declining by 2.28%. I suspect this was part of a combination of that strengthening pound, because a lot of their revenue is generated across seas, and also the idea that they did go ex-dividend on the 24th of December, although usually what would happen is on the ex-dividend date, the value of that dividend would be subtracted from the share price, as traders typically try to take profits, although the dividend was only 7 pence and that would not justify a 2% move, but not every market move is justified accurately in the markets. Hallmark was also one of the stocks I bought this week. I increased my position size from 36 shares to 50 shares of Hallmark. I remain very bullish on the company and like their active management over the companies in their portfolio, and think over the longer term, especially as they're able to really kick into gear with their mergers and acquisitions, that they could be a strong performer coming out of this recession. Hallmark now represents 6.8% of the portfolio, which is still massively underweight compared to the 15% target allocation in the portfolio. The top performer this week was, of course, Boohoo. Shares have increased by 10% since Monday. I suspect it's due to a combination of obviously getting that certainty around the auditor, but also we may be seeing a run up over the Christmas period. That's because typically with Boohoo stock, they seem to gain a lot of investor sentiment prior to the results, which had happened in September earlier the year. There's a trading update in January. This could mean that Boohoo's share price rockets upwards unsustainably, and then on the actual trading update it may have been worse than investors had expected, leading to a correction in the share price, followed by probably more media articles slamming the company. The main thing to say here is that hopefully 2021 can be a very strong year for the company. I suspect that a lot of the retail stores that were closed due to being on the high street are therefore not going to make as much sales, and therefore the online e-commerce businesses, the likes of Amazon, the likes of Boohoo and ASOS, I think they're going to benefit very significantly. And honestly, this is a complete speculation and a pure guess, but we may be seeing 40% growth on their revenue, although we must also account for the idea that their guidance, I believe, was lowered earlier in the year. So it really depends on the outlook of this trading update. But what is really exciting about Boohoo and their growth potential is their US exposure. At the moment, it's significantly less than their UK exposure, yet can be growing at a much faster pace, and the US has a much bigger market for this product. Therefore meaning that once they can diversify out of the UK, get into the US and really grow, then we could see a very strong amount of demand, and this company could truly be a very strong growth stock. I still hold 2,500 shares of Boohoo. I'm not planning on increasing this anytime soon. I need to diversify the systematic risk, as at the moment around about 46% of the portfolio is with Boohoo, and the off chance that there is more governance issues could really put a dent in my performance. This week I also finally disposed of Softcat, selling the remaining 20 shares. I'd mentioned this in the past, but briefly, the reason for selling is because they're in an industry with very low barriers to entry. Softcat themselves had started in a shed, selling software to clients. I don't think that they could really build a sustainable moat, but I bought them originally with the idea that they could build a stronger moat, but they don't have that, and I don't think it's very likely that they will gain this unless they get a lot of private clients that go to them regularly. Whilst their shares had been rising consistently over the last few weeks, This stock has proven to be very cyclical in the last year, and that's due to a lack of financial stock updates, and I think this trend will continue to happen. Sure, they may have their results, I believe, in March, but I think in this time period the shares may peak upwards and then go down gradually on a slope. I've decided I don't want this cyclicality in my portfolio and to just cut the position at that. I've reinvested those profits or losses elsewhere, although I haven't worked out whether I've made a profit or a loss from Softcat just yet. The main thing is that I have no regret selling this position, even if for the bizarre, obscure chance that SCT shares double in the next month. I'm not going to go, oh, I wish I hadn't sold my position, simply because there's no point me putting my energy into that. I've made the decision I need to trust my gut now, even if it means I'm missing out on some potential gains. I need to focus on the holdings on my portfolio. However, for those of you that are invested in Softcat, I do wish you the best of luck. They are a quality company. I just invested due to those industry-wide issues. Hopefully Softcat will continue providing high shareholder value, and if you're interested in value, if you sign up to Trading 212 using my link in the description down below, you can get a free share worth up to £100 when you deposit just £1. Link in the description down below. The other stock I bought this week was the London Stock Exchange Group, and you may be wondering, well, this isn't really a value deal as they've been very stagnant in share price for the last 3 weeks. And that's true, they have been stagnant in share price due to the likelihood of the Refinitiv acquisition going through was increased by a partial confirmation earlier in the month. However, I think now is a time that there could be a lot of long-term value. It's very likely that this acquisition will go through, and therefore I would like to put more equity into the company because I think they will be a much stronger company when you combine London Stock Exchange with Refinitiv. Right now, I think that if they're able to use Refinitiv to compete in other areas, increase their revenue and earnings growth, then their dividend growth could also increase more, but mainly their shareholder returns could be higher. They're a staple company, but they're also a large, mature company, a market cap of around £32 billion. And so obviously they can't just 10 times in the next year, but they could certainly be a consistent performer in the portfolio. And, over the longer term, they could become one of the largest stocks in the FTSE 100. Currently, LSE only represent 4.6% of the portfolio, and I think that's very much underweight. And over this next month, which it is assumed that they will complete this transaction for Refinitiv, I would like to really boost my equity in this stock and hopefully build it up, because I would like to have more equity and hopefully more performance tied to this fantastic company. The stock tip of the week may be more different to what you were expecting. In the market, I think there's not always opportunities to buy and sell, and so I believe now might be a very good time to start building cash. The Christmas period is tough financially on a lot of people, and so just saving cash on the sidelines, be it for emergencies or for your own stress levels, could be just a wise idea. I've personally been rebuilding my emergency fund after the graphics card and that computer behind me had blew up. Furthermore, I've also been developing a cash position for my investments should there be some bargains after this Brexit transition period. I also believe that furlough is unlikely to be extended by a much more significant margin than it was last time. It may be extended into May or June, but I can't see it going much further than that. We may also be put in a very long lockdown, and this could mean that we could be in a lockdown for 2 to 3 months, which would hopefully halt the pandemic enough whilst we are vaccinating the general population, and therefore benefit like that. Therefore, we may have this opportunity now, while some of us are in tier 4 lockdown and some of us aren't, to therefore save the cash that you would otherwise be spending, have that either to be building your emergency fund in case that odd thing happens that really is a detriment to your finances, or use that money to buy some bargains in the stock market, which I think may happen as we see a transfer of wealth back out of the value stocks into the technology stocks, at which point there may be more of a discount on these value stocks. I personally think there is a high percentage chance that I may be made redundant if furlough ends in April, and therefore I have been preparing that emergency fund, but I've also got to prepare in other ways too. Therefore, my investments have been going at a slower pace just to make sure I have that cash on the sidelines and I'm protected. I also feel that in the year of 2021, we're going to see a lot of stocks that people were buying into thinking they would have resilient or strong performance. As their full year revenues and earnings are released, they may show that they are a lot worse than people or the investors had expected, and they could see significant sell-offs or crashes. This could be that opportunity to buy in, and therefore a cash position could be very important to investors. If you're interested in my 10 UK stocks to buy in 2021, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a merry new year.